Happy New Year, everyone. It's been 2 weeks since our last episode, and I know by now you might have even forgotten the existence of this show. But I have to show that I did some work during my appraisal, so here I am back with another episode of Who Said What. For those of you tuning in for the first time, welcome to the show. I'm Krishna, and this is the show where I take the most interesting quotes from leaders, policymakers, and industry giants and peel back the layers to uncover what's really being said and, more importantly, what's not. Today, I have 4 interesting things to share with you, but before that, I have a quick question. If you have any feedback or suggestion as to how I can improve the show, please let me know in the comments below. With that out of the way, let me get started. In the first story, I'll talk about diamonds. I came across this chart from LiveMint and it immediately caught my eye. It shows 22 years of zero returns for diamonds. Let that sink in. 22 years. Over 2 decades, diamonds as an investment have basically gone nowhere. And yet, for most of the time, we've been told by marketing campaigns like De Beers that diamonds are the ultimate luxury, the pinnacle of value, something that's forever. So what really went wrong? Let's rewind a little. De Beers practically built the modern diamond industry with its genius marketing, "A diamond is forever." We might have all seen it. And it wasn't just a tagline. It was a way to convince people that diamonds were rare, precious, and a must-have for every engagement ring. And for a while, it worked. But here's the thing about diamonds. Unlike gold, which has universal liquidity, diamonds don't have a reliable resale market. I mean, look at the graph again. And now, lab-grown diamonds have entered the scene and flipped everything upside down. I've written about this sector a bunch of times on the Daily Brief because this topic personally fascinates me a lot. But coming back to the story, these lab-grown diamonds are identical to the natural ones in every way. Chemical structure, physical appearance, everything. But they cost a fraction of the price. For a buyer, it's a no-brainer. Why spend 3 to 4 lakhs on a natural diamond when you can get a lab-grown one for 50,000 rupees? Add to the fact that lab-grown diamonds are marketed as sustainable and conflict-free, and you start to see why they're becoming so popular, especially with the younger buyers. This shift to LGDs or lab-grown diamonds is hitting traditional players hard. I'll take the example of De Beers again because they had to do something they had never done before, which is cut prices. They've been forced to cut diamond prices by up to 15% this year, a huge deal for a company that usually tries to keep prices steady at all costs. They're also stockpiling rough diamonds, which is worth $2 billion, their largest inventory since 2008, and they're hoping demand will bounce back. In India, this segment is growing at around 15 to 20% annually, and with companies like Trent launching their own LGD brand, which is POM, for Indian buyers, these diamonds are making luxury more accessible than ever. I'm done with this story for now, but if there are any more updates, I'll make sure to come back and update you about it. The next story is quite interesting. It's about the Indian startup ecosystem. I was coerced and threatened. I had just 24 hours to agree to sell my shares and resign. That's what Amarendra Sahu, the founder of NestAway, told investigators, pointing fingers squarely at some of the biggest names in the venture capital: Tiger Global, Chirate Ventures, and Goldman Sachs. Sahu, who co-founded NestAway in 2015, had seen this company, once valued at 1,800 crores, sell for measly 90 crores in 2023. And now he's accusing his investors of forgery, intimidation, and reneging on promises that they made to him as the company unraveled. But I want to take a step back and unpack this slowly. You see, the story isn't just about NestAway or one disappointed founder. This is a story of the golden days of sky-high valuation, the lack of oversight during the funding frenzy of the COVID era, and the fallout that we are still seeing. NestAway, once a promising rental housing startup backed by big names like Tiger Global and Goldman Sachs, seemed to tick off all the right boxes. By 2019, it was a leader in the space, valued at 1,800 crores. But cracks soon appeared. Competition grew, service quality dipped, and the pandemic crushed urban rental demand. By 2023, the company was sold to Aurum PropTech for just 90 crores. The founder, Amarendra Sahu, alleges that investors forged his signature, coerced him into stepping down, and reneged on a promised 11.72 crore payout. NestAway's story isn't an isolated case. It's part of a larger pattern of turmoil in the India's startup ecosystem, especially after the COVID-era funding boom. Take Zillingo for example. Once a billion-dollar unicorn revolutionizing the fashion supply chain, it raised over $300 million from marquee investors like Sequoia Capital. But by 2022, things fell apart. CEO Ankiti Bose was suspended over alleged financial irregularities and the company eventually liquidated. She has denied wrongdoing, claiming she was targeted, but Zilingo's collapse left a trail behind of lost jobs and questions about governance. Then there's Go Mechanic. It was positioned as a disruptor in the car servicing market. It had raised money from VCs like Sequoia Capital and Tiger Global, but then the founder admitted to inflating revenue numbers. An audit revealed fake invoices and fictitious garages, forcing investors to write off their stakes and pushing the company into insolvency. Now, what ties all of these stories together? The funding boom of the pandemic years. When COVID struck, venture capital poured in startups like never before. With the world in lockdown, digital transformation became a buzzword, and every VC wanted to back the next big thing. Companies raised money at valuation that in hindsight seemed absurd. Founders were flush with cash and investors were falling over themselves to write bigger and bigger checks. There wasn't much focus on governance or business fundamentals. Growth was all that mattered. For a while, this worked. Startups scaled rapidly, valuation soared, and everyone seemed to be winning. But then came the bust. As interest rates rose and global liquidity dried up, the tide went out, exposing who had been swimming naked. The once sky-high valuations came crashing down. NestAway's 1,800 crore valuation turned into 90 crores. Zilingo went from a unicorn to liquidation. Go Mechanic's growth was revealed to be smoke and mirrors. The common thread in these stories is the lack of oversight on both sides. Investors were so eager to chase growth that they overlooked governance. Founders, incentivized by ever-rising valuation, often took shortcuts, fudged numbers, or failed to build sustainable business. It was a perfect storm, and the fallout has been ugly. In the third story, I look at a comment that was made about the banking space. So recently, SBI's chairman C.S. Setty made this comment on CNBC TV18.
So I don't think there will be too much cost escalation on the deposits. Obviously, all the banks are focusing on activating their networks, branch networks, and also redesigning the products and processes. How do we retain and mobilize more deposits?
Now, since we have an in-house banking expert, Kashish, who also writes the daily brief with me, I asked him to explain me the nuance and give me all the context in case I miss anything. Let me now explain what the chairman is saying. See, earlier this year, we were in a situation where people like you and me were depositing money into banks at a slower pace than banks were giving out loans. This was a risky move. Basically, banks were stretching themselves thin, handing out more loans than they probably should have. Even the RBI governor back then wasn't thrilled about it. We've talked about this before on the daily brief as well. I'll link it in the description, but here's the gist. The RBI got serious, urging banks to fix this imbalance. Mobilizing more deposits quickly became a top priority for every bank's management to-do list. They really didn't have much of a choice. When CS Setty took charge, he had to think fast and compete for deposits. At the time, the banking world was buzzing about how this so-called war for deposits was drying up costs for banks. But Setty had a different take. He publicly stressed that deposit growth isn't just about offering high interest rates. It's also about delivering better customer service and innovative products. He even talked about introducing a systematic investment plan or SIP style product for fixed deposits, which, if you think about it, already exists as recurring deposits. But hey, he wanted to rebrand it for Gen Z. Now here's where things get interesting. Over the past year, SBI's deposit costs have been seeing the biggest spike among large Indian banks. Now, to be fair, these numbers reflect the strategy of Setty's predecessor, not his own. But he clearly wants to change this. SBI already has one of the lowest deposit costs in the country, and he is determined to keep it that way. Fast forward to his latest interview, he is essentially calling the top on deposit rates. He believes deposit costs won't go any higher from here. This is a big deal because rising deposit costs have been eating into banks' profitability across the country. If deposit costs stabilize and loan rates hold steady, margins could actually improve, boosting profitability. But let's be honest, this isn't exactly a groundbreaking prediction. Here's why. First, the rate cuts are coming. The repo rate, which is the rate at which the RBI lends to banks, is expected to drop soon. When this happens, the cost of money in the economy decreases. Here's why this matters. See, when repo rates go down, banks lower the interest rates on loans, making borrowing cheaper. At the same time, they also reduce the interest rates offered on deposits because they don't need to compete as aggressively for funds anymore. For depositors, this means that high returns on fixed deposits or savings account become harder to find. but they'll likely accept these lower returns because alternative investment options like bonds or market-linked instruments also offer reduced returns in low interest rate environment. Essentially, when everything yields less, depositors adjust their expectations. The gap between deposit growth and credit growth is gone. Banks were under the pressure by the RBI to attract more deposits because they were giving out more loans than they could support. Now that the gap has closed, there's no urgency to keep raising deposit rates. In short, SETI's statement is less of a prediction and more of a confirmation of what's already happening in the economy if you've been paying close attention. For the last story, I want to talk about steel and China. Tata Steel CEO TV Narendran recently shared a big concern. He talked about how India's growing steel demand, which is up by 8%, could be a massive opportunity for India. But there's a catch. China's cheap steel is flooding the markets everywhere, including India, and it's starting to feel like a problem we can't ignore. Narendran's message was clear. India needs to take a stand just like the US, Canada, and European nations have already done to protect their steel industries. Let's talk about China for a second. China is the world's largest producer of steel. I mean, it controls more than half of the world's steel production. But here's the issue. China doesn't need as much steel as it used to. Its economy has slowed, and big infrastructure projects, the kind that gobble up steel, aren't happening at the same pace. So, what does China do with all this extra steel? It exports, and not just at regular prices. It's sold at rock bottom rates. To give you an idea, in September 2024, Chinese steel was being sold to India at $462 a ton, while Indian made steel cost $574 a ton. Even after adding import taxes, Chinese steel was still over 4,000 rupees cheaper per ton. It's no wonder local steel makers in India are feeling the heat. They can't compete with prices that low. Dumping, which is selling products below market value, isn't just a pricing problem. It can hurt local businesses so badly that they might have to shut down. And once they are out of the picture, guess who controls the market? The same country doing the dumping. This is why countries like Brazil and the US are already putting up barriers. Brazil, for example, has set strict limits on how much steel can be imported from China. If imports cross that limit, they are taxed heavily. The US has gone a step further, slapping huge tariffs on Chinese goods like steel and even electric vehicles. Meanwhile, India's steel story is very different. Demand here is growing fast thanks to infra projects, urbanization, and rising consumption. India is now the second largest steel producer in the world, accounting for around 10% of the global production. Companies like Tata Steel are investing heavily to meet this demand. For instance, Tata recently commissioned India's largest blast furnace at its Kalinganagar plant in Odisha. This is a big deal, but the flood of cheap Chinese imports could threaten such investments. For years, China's steel boom was driven by government spending on massive infrastructure projects like highways, skyscrapers, and railways. But now, with fewer of these projects in the pipeline, Chinese steelmakers are stuck with surplus production. And they are doing everything they can to get rid of it, including shipping it to countries like India. Worse still, China is using trade agreements like the Asian FTA to reroute its steel through other countries, avoiding higher import duties. For instance, a lot of Chinese steel coming to India now gets routed through Vietnam or South Korea. This clever maneuvering makes it even harder for local producers to compete. This is it for today's episode of Who Said What. Please let me know in the comments below what you think of it.